Welcome to the Midday Market Update for June 2nd, 2020. My name is Kevin Hill. Here, as always, to my right is Michael Vincent.
Good afternoon, everybody. Welcome. Welcome to our interactive show, the Midday Market Update. So get your interactive, as I said, so get your comments, your questions in on FreightWaves LinkedIn. I think we're live on LinkedIn right now and Facebook as well. And we'll get those answered as best we can.
Yes, please comment, ask questions. Every Tuesday and Thursday, we're here with the Midday Market Update at 12 Eastern Time, sharp.
Right on. Who we got on the show today?
Today we have a regular cycle of news with Andrew Cox, a senior research analyst here at FreightWaves, and then our director of freight market intelligence, Zach Strickland, to talk about the freight markets, and then our lead economist, Anthony Smith, talking about all the economic numbers. Then we have Michael
Ryan, managing partner at the M. Ryan Group.
Yeah, the M. Ryan Group.
And
be here at 12:30.
Yes, and the always exciting John Kingston.
The always exciting John Kingston at 12:40 to talk about loans and the debt cycle with the trucking market. So that's at 12:40. And let's kick it off right now with the news. What do we have on the headlines, Andrew Cox?
The startup producer of Class 8 trucks running both on battery and on hydrogen expects their shares to trade under their name later this week on the NASDAQ. The Nikola listing will be a culmination of a merger with Vector IQ, who is a special purpose acquisition company. They raised several $100 million for its public launch. Nikola decided to go against the IPO route, as many companies have been doing recently. Currently, Nikola trades under the ticker VTIQ, but this will change to NKLA on Thursday. So in anticipation for the merger, VTIQ shares have tripled in the last 2 months or so, since March 18th when the merger was announced. And Nikola plans to begin battery production in their truck production with their partner in Germany in 2021, followed by the production of hydrogen-powered trucks in Coolidge, Arizona, which is a new plant about 50 miles outside of Phoenix. That is going to happen in 2023. Nikola's first objectives, Trevor Milton said, their CEO, is getting the joint venture in Germany up and running, while also building the first 2 hydrogen stations alongside the U.S. routes that Anheuser-Busch will be using to cover. Anheuser-Busch, that is, has ordered 800 trucks from Nikola.
Andrew, do you think one of the aspects of going public, or one of the pluses, might be Nikola might be able to emulate maybe Elon Musk a little bit and use that as a branding and marketing vehicle going out? Since they're a public company now, they'll be more in the discourse of the investing public and the general public at large.
Yeah, I'd say there's, of course, pros and cons with going public. One is that it does elevate Nikola and elevate Trevor Milton on at least the social and cultural side of things. He does have a decent presence on Twitter, nothing like Elon Musk by any means. But they're also, and another good thing that Trevor Milton said that comes with this is that it kind of gives them some validation. It gives them some credit with investors. They're no longer just a vaporware company that puts out really pretty, cool projects on the internet. They now seem solidified now that they're trading on the NASDAQ. But yeah, I think that there's pros and cons that comes with it. I think that Nikola is now positioned well. I think there's a lot of investors that are really excited about them. Trevor Milton has said publicly that he believes they'll be the most valuable trucking company in the world in a few short years. And investors are really getting behind that idea. That's why you've seen such a upward pressure on the stock the last few weeks.
Yeah, he said in effect they've basically got $1 billion in cash, no debt. They're moving forward. They've got $10 billion in orders, I think, Andrew, is what he said. And some pretty good go-to-market strategy with 700,000-mile leases. It includes truck fuel and maintenance costs at 95 cents a mile, I believe it was.
Yeah, precisely. They have a pretty clean balance sheet right now. They've been able to raise a lot of money through this SPAC vehicle that they use to get public. Also, they have no debt, as you said. And yes, they have a really good go-to-market strategy. I think it's much different than most other trucking companies. They're focused solely on leasing these vehicles. They're never going to give up ownership. And yes, they're bundling a 700,000-mile lease, includes fuel and maintenance. And they're expecting it to be a few cents cheaper than that of a diesel alternative. And it will have 0 emissions.
It's really interesting, and they're putting these, because it doesn't really say where these routes are, but they're putting up the 2 hydrogen fueling stations on routes that AB AB Anheuser-Busch, AB uses, and AB's where they've committed to at least 800 trucks. So as those move forward and they prove out that concept, then those hydrogen fueling stations are there for new leases and new trucks and more trucks and advancements. So
yeah,
I'm looking forward to it.
All about the infrastructure.
Yeah,
right?
it definitely is.
Infrastructure fueled trucks. Amazon is getting in the blockchain arena, isn't that right?
Yeah,
Andrew?
Kevin, so Amazon received a patent for a blockchain system that would allow verifiable tracking of an item through a supply chain using a distributed electronic ledger, according to a filing dated May 26th. The patent acknowledges the rapid increase of systems and databases that can often lack transparency, coherency, referential integrity, and security, and explains how the reliable, immutable nature of blockchain will ensure that consumer goods sold on Amazon and e-commerce site are authentic. This has been a really big problem for Amazon in the last few years. They've had a lot of gray market items that could be counterfeit or may come from some sketchy parts around the world. So they're doing their best to try to ensure that all of these products are real. They're doing so to try to bring back some of the major brands that have left the platform in the last few years. Some include Nike and Birkenstock, among others. So they are hoping that this blockchain initiative will woo them back on the platform.
It's an interesting one to me. Obviously with BIDA that we've been involved in, and I was in the early days of it and looking at blockchain and its uses. And, the third parties in here that are like fake products and et cetera. Wasn't it more of a duped at purchase than a bought legitimate but got fake? I mean, wasn't that kind of the issue that's going on Amazon?
The seller was legitimate?
Yeah, the seller wasn't legitimate.
It wasn't legitimate.
Right.
Yeah, I think that was most of the issue.
Yeah,
the seller wasn't legitimate, and they were selling counterfeit goods as well, right? Exactly.
It wasn't like they went on Nike, bought Nikes, but it came from Nike with a CK instead of just an NIKE, right? I mean,
yeah, they were really good counterfeit.
Yeah, they were really good,
goods.
but I mean that was the thing. They're being duped at purchase. I think was a lot of the issue there. So it'd be interesting to see how blockchain actually assists in that. Verifying that it's actually Nike from Nike that you bought. I get that.
But. Yeah, and that's one of the reasons why Nike has withdrawn selling on Amazon.
Yeah, a number of them have, and they're hoping to get them back with these type of measures. So,
yeah. And you can read more about this story on FreightWaves.com. Like our others, that was Linda Baker that reported on that one. And next we have Alibaba. Alibaba getting into the freight matching game on ocean and air. What are the details on that, Andrew?
Yeah, Kevin, Chinese e-commerce giant Alibaba has announced the launch of Alibaba.com Freight, which will help small and medium-sized businesses to simplify the movement of their bulk freight. So their freight matching service will work via a dashboard, a transparent dashboard that lets users instantly compare, book, manage, and track ocean freight and air freight in real time. The freight matching platform on the back end is being powered by the logistics freight routing company Freightos. And there's actually a couple other things that Alibaba is doing besides the freight service. Alibaba.com has announced 2 more products and services, including a payments terms that will help users better control their cash flow, as well as an online trade shows USA, which looks to connect U.S. manufacturers and wholesalers with business buyers via virtual events.
Very interesting, and part of it as well is their payment terms that Alibaba is putting behind this, right? Was it then like 60-day terms for the goods and the shipping? I saw.
Yeah, that's right. It's in full detail there in the article that Vishnu wrote. It goes into full detail about the payment terms. Everybody can check it out there.
Yeah, so it gives those smaller businesses a little bit of a financing of inventory almost, right? And of trades that they are difficult to get through banks and that type of stuff, right?
So it gives those small sellers a leg up to be able to more efficiently import, especially on the North American side, import those products that they're reselling on Alibaba.
Yeah. Yeah, absolutely. And these times during this recovery coming through out of these things, some extra payment terms would be a welcome sight, I would think, by small businesses trying to get the recovery going, jump-started, right?
Exactly right.
Very cool.
On the autonomous, on the autonomous vehicles auto, we have a story out today by Nate Tabak on some fundraising. Isn't that right, Andrew?
That's right, Kevin. ClearPath Robotics Auto Motors has closed a $29 million Series C funding round that is going to help them place more of their robots into warehouses and manufacturing facilities around the world. Auto is based in Ontario, and it announced this new funding on June 1st. Some of the investors include Kensington Private Equity, BMO Capital Partners, Export Development Canada, and RRE Ventures. Auto produces 3 different models of autonomous robots that operate on a proprietary platform for warehouses and manufacturing facilities. Some models can move entire pallets into cross-dock trailers. ClearPath CEO and co-founder Matthew Rendall said autonomous robots improve the safety of the workers and strengthen the supply chains in a post-COVID world.
This one fascinates. I love the robotics and especially autonomous vehicles. Very cool. Inside the 4 walls, which we're talking about here with these automotors, is really cool stuff, and it just reminds me of back in my roadway days when we shut down the drag line. And everybody's watching that remembers LTL drag lines on their break bulk docks. It wasn't really cross docks. Came off, went on a drag line and rode forever, or sat in a bay, and then we you took that out, went to electric forklifts. The day we shut all that stuff and went to electric forklifts, we were all standing there like, uh-oh. There was no noise. You couldn't tell anything. It was going on. Productivity just died, and we had to put artificial noise. So we've come a long, long way. It's really cool stuff. Thank you, Andrew.
That is cool. And so our next article is from Greg Miller here on FreightWaves.com, and it's about the reignition of trade war fears and trade wars in general. Isn't that right, Andrew?
Yeah, Kevin. Greg Miller says that the Phase 1 trade deal between the U.S. and China isn't quite dead, but it is most certainly on life support. The two superpowers are having deteriorating relations in the wake of the Chinese security law covering Hong Kong, has implications for the container, tanker, dry bulk, and gas shipping demand, as well as the shipping stocks. President Donald Trump alleged in a speech on Friday that China ripped off the United States like no one has ever done before and got away with theft of hundreds of billions of dollars a year, that China raided our factories, offshored our jobs, gutted our industries, and stole our intellectual property. Unlawfully claimed territory in the Pacific Ocean, threatening freedom of navigation and international trade, broke its word on ensuring the autonomy of Hong Kong, and instigated a global pandemic. So you could say that trade tensions and overall tensions between the U.S. and China really haven't ever been higher.
Yeah. The good old days. Remember when this was all we had to worry about?
I do remember when this was all we had to worry about. We're still worrying about it now. It sounds like coming back up.
Yeah, we are, and I wonder how much the effect this is going to have on the recovery and moving forward, right? Because when you look in there and you dig into a little bit more of Greg Miller's article there, and he does such a great job covering maritime, and he's talking about the unblanked sailings and some of that stuff. You're seeing a lot more volume from other trading partners, which I think is quite interesting because this kind of makes that happen. But then as we go through recovery, you're talking about your supply chains and whether you're going to do just in case or just in time and diversifying your supply chain. This causes that to happen even more, right?
It does. And hopefully demand comes back online in a very quick manner so that it becomes a worry. It's, I guess, a good problem and a bad problem.
Yeah, I mean, when we first came into the pandemic and so on, and things were moving in manufacturing, it was almost like the trade wars previously. Zach Strickland and I, our director of Freight Market Intelligence, talked about. I wonder if the trade wars were kind of like an inoculation, right? Type of thing and that's really what you're looking at when you're moving forward with the supply chain. And we'll talk to Michael Ryan about that a little bit later. He'll probably have some insight on that and what it looks like moving forward. But it's really inoculating your supply chain from disruptions.
It is. It's a whole game of cat and mouse, really. And talking about freight markets, we now have Zach Strickland, our director of Freight Market Intelligence, ready and set to go to talk about what he's seeing in SONAR.
Pretty strongly. Those of you that follow us online and have SONAR subscriptions, you'll know that our outbound tender volume index is a 7-day moving average. And so during those holiday periods, we do trough out a little bit, see lower volume almost artificially for about 5 days, and then we kind of break out of that. So we came out of it, and kudos to Mike Vincent for calling what I think is actually a really close prediction to what it would be like coming out of that. About 11,300 right now, and you were calling for about 11,400, right, Mike?
Yeah, 11,422. Yeah.
So, I mean, the significance here of this number, other than the fact that you were pretty close, was the fact that this is a very high value for the outbound tender volume index. We traditionally see higher volumes during the month of June, but considering the coronavirus, COVID-19, whatever you want to call it, has really had put this layer of uncertainty over whether or not we were going to see strong volumes, seasonal volumes, et cetera, moving through the freight market in this season.
So we do have a viewer question here about the dry van market, and it is from Paul Zabrowski. He's a president and COO at PAS Transport, and he's asking what markets are rising in the Midwest for dry van.
Yeah, that's a great question, because it's funny he asked, because the Midwest is actually the area that we're seeing the most activity right now as of this week. So we were talking about it this morning on FreightWaves Now, where the Joliet, Chicago area has really seen a substantial increase in volume. Joliet used to be one of the largest freight markets in the United States prior to 2019, where it really just fell off the map, losing a lot of market share value over the last year or so. But here in the last week, it's growing strongly. I believe about a 15 to 20% increase week over week in terms of outbound volumes. But combine that with a few of these other larger markets in the Midwest, such as Milwaukee, Indianapolis, and also Detroit. Detroit, of course, due to the automotive sector influence there, having a big impact on that freight volume. So we're seeing a pretty big increase in volumes in a lot of the bigger Midwestern markets this week.
Yeah, Indy, Memphis, Columbus, Ohio, et cetera. And is that so, Zach? When we look at the recovery and we see what's going on, we saw some different patterns. Like last year, we saw I believe like early in the year we were looking at volumes and the strength were on the coasts, right? And it never, and particularly on the West Coast, and it never really kind of materialized in the inner or central United States. And now we're seeing this very strong movement that is not at the ports. Is that indicative of a stronger recovery, do you think? Or does that tell us anything?
I think it's exactly what you said. There's some fragmentation in this recovery process. Seeing where these volumes are moving off the West Coast into the Northeast, into the middle parts of the country, that doesn't necessarily always translate to immediate freight movement. It can go to warehouses and sit for a period of time. But what's significant about this recovery in the Midwest is that a lot of the volume growth has been on the longer haul freight. So stuff moving more than 450 miles or so has really increased here over the last week or so. Which that to me is pretty interesting factor. It means that there's some production going on there, or some significant repositioning of the freight. Now that could be freight that's moving off of the rail, as it's there's a large intermodal hub in Chicago, Memphis, of course, another large one. But a lot of that freight does get transitioned out of the rail in Chicago and then starts to be distributed throughout the United States, especially as it's coming off the West Coast.
Hey, Zach, we have another viewer question here from Jonathan Payne, and it's what's been happening to the average length of haul with higher freight volumes and the increase in tender rejections?
So traditionally what we would expect to see here, especially after this huge long haul growth, the freight that moves over about 450 to 800 miles, once we see that growth, we tend to see it followed thereafter by short haul volumes. That does not appear to be the case just yet. And some of our data, of course, like I said with the Midwest, it's kind of shocking that we're seeing some long haul freight movement come out of the Midwest. But again, the Midwest has been very subdued this year so far. So I would still expect to see some short haul volume growth, especially around some of these major metro areas. As the recovery continues, I think we're going to see a pretty strong June moving forward. I was reading an article on FreightWaves.com this morning about the LTL industry also seeing a lot of freight volumes increasing. And one of the aspects of this freight volume increase was they were seeing higher weight per shipment. Which is indicative of larger shippers, continuing to produce, and not some of these smaller mom and pops. So these larger shippers being active is a pretty good sign of things moving forward. I think that you're going to see a lot of these freight volumes continue to increase and drive a lot of freight throughout the June month. And again, eventually that will transition into some short haul freight volumes, and eventually the capacity is going to have to tighten, even though we haven't seen a substantial increase there just yet.
Yeah, I mean, what you said about the LTL is the average weight per shipment. That's kind of a leading indicator of that. That kind of happens once truckload drops and right before it starts to pick up again, or during that pickup, right? When you start to see that demand start to increase from the larger shippers, like you said, you'll see that till those large orders start to build the truckload-sized orders, right?
That's accurate. They, traditionally, and I don't think that this is exactly that just yet, but you do start to see when capacity starts to tighten, a lot of these shippers will chop up their larger shipments to get that guaranteed capacity that LTL carriers provide versus the truckload. But I don't think that they're having that much trouble getting capacity right now from the truckload carriers. So I think this is a pretty clean, by nature, they are having larger shipment type situations.
Yeah, I agree. I wasn't trying to imply that it is tightening of capacity, but more of a good sign that the larger shippers are producing and maybe starting to grow and strengthen.
Right. Yeah, especially right now. I mean, the larger shippers are going to be the ones that drive the majority of the recovery that lasts throughout the summer.
Yeah, it seems like there's green shoots going through all the markets right now, or
there's positive indicators all over the place. And I was looking at the OTVI, Zach, this morning, and it is all length of hauls that are recovering pretty darn nicely right at this moment with the volumes, anyways. So hopefully that continues.
Yeah. And one quick last question for you, Zach. What about the refrigerated markets?
Yeah, the refrigerated market continues to grow. It's this time of year. Produce season is in full swing. It continues to be in full swing. Again, hasn't translated to 2018 level rates or anything like that, but it is still growing and it's strong. It's actually what you would want to see. You see this very stabilized growth pattern. It's not showing intermittent spikes or anything like that. It's more a stable, steady growth, not contracting capacity too much. But it is, continuing a nice, healthy trend line up right now, which should continue through the rest of for the next couple of weeks for sure.
Thank you very much for your time today, Zach Strickland. He's our Director of Freight Market Intelligence.
Thank you, Zach.
Here at FreightWaves. What are your takeaways?
My takeaway is it looks like we're looking at a lot of indicators that would lean more towards a V. I said that last week, looking at things and just looking at the trends and how this recovery is looking, and are now hitting and clearing the holiday week. The jump up is what I was expecting over last year and the year before as we ramp up, and it looks good, and you see it all over the place. Air cargo is obviously demand's been there, but you see the airlines with the belly capacity starting to bring back some of the routes, which is positive. Sailings, not a lot of them, but they're unblanking sailings, and the 40-foot equivalent pricing, China to North America, is not only sustained, but it's growing, which would indicate demand.
Yeah. And speaking of economic recoveries, a lot of that's tied to manufacturing. And Anthony Smith is here now, our lead economist, to talk about the latest PMI numbers. How did that turn out, Anthony?
That's right, Kevin. We have the latest PMI numbers from the Institute for Supply Management, and we saw an increase. So when we're looking at the overall PMI, which is combination of many other components, we saw that it increased to 43.1 from last month's 41.5. So this is an upward movement, still below that 50 benchmark level. So as you know, 50 is anything above 50 is indicative of expansion, while anything below 50 is indicative of contraction within the manufacturing industry. So when we're looking at that, it's still in that contractionary period, but this is the first upward movement that we've had since the ramp up of the coronavirus pandemic. So that's really the big thing to note. The other big thing to note, as I mentioned earlier, this is broken down into components. The new orders component moved up to 31.8 from 27.1. And so to harken back to a few weeks ago, it's less bad than what it was, but this is an upward movement, so that's showing that potentially April found the bottom, and we're starting to see things ramp up a little bit more here in May.
Interesting. So, Anthony, can you explain the 43.1? It was the PMI, right? Was that 43.1? You said.
That's right. That's
can you explain that a little bit? Because you said 50 is the mark. Anything above 50 means expansion. Anything below it means it's in a contractionary state. So what is that year over year? Does that mean that it's contracting but but at a slower rate versus last month, or slower rate versus year over year? What is a? Can you explain that a little bit?
Yeah, yes, certainly. So when we're looking at the PMI, it's, as you mentioned, anything below 50 is indicative of contraction. Even if it is below 50 and we're seeing some upward movement, that's showing that it is still contracting, but at a slower pace. So that's where it gets into almost a rate of growth format. Now, this is going to be released on a month-to-month basis. And so when we're looking at these latest numbers, this is compared to last month. So this is showing that the overall numbers are improving compared to last month's results. We're looking at overall manufacturing. As I mentioned, this is broken out into components. So we have things like production, employment, supplier deliveries, inventories. We did see a little bit of a bump up in inventories, now at 50.4. Employment also increased to 32.1 from 27.5. So that's kind of indicative of the reopening of many economies throughout the country, especially as Mike Bondissel spoke to a little bit earlier on today on FreightWaves Now, especially on that East Coast side, where we're seeing a lot of manufacturing activity really around in that market where it's more prevalent than in some parts of the West Coast. So when we're looking at manufacturing, this does show that there is some upward movement here. Now, the big thing is, as I mentioned, it's still under 50. It's still under that expansionary benchmark level. The other thing is that there is going to still be headwinds here. So manufacturing, as we all know, was already on shaky grounds before the coronavirus pandemic. And now things are a little bit even more so uncertain. Things have been exacerbated, if even more so than when we initially had trade war talks. And so this is going to be something that's going to really kind of be a damper on potential capital expenditures. This is going to be a damper on many businesses that are looking to have any kind of manufacturing upgrades in their facilities. And so there are headwinds, but this does show that there is some upward movement here in the coming months.
So green shoots, but maybe somebody stomping on them.
Anthony.
That's what it sounded like, right? I mean, they're all positive signs, but like you said before, we're still trying to recover from the coronavirus, but we still have the trade war that could.
We do. And one of the numbers that jumped out at me this week, because it's all about spending and saving, the savings rate spiked through the roof. I think it was like a 33% increase. Can you give us a little bit more details on that, Anthony?
Yeah, so we're looking at spending versus saving. We did see that savings have increased, although spending has not. This is despite the efforts by the government to really kind of provide an additional stimulus for many Americans throughout the country. Of course, so we saw that increase for unemployment benefits. I think it was additional $600 on a weekly basis. And so that's really showing that Americans are saving. So that kind of talks to that near-term confidence, right? So when consumers are confident, they're going to spend. Right now, the outlook is still shaky. Although expectations in the upcoming 6 months are a little bit more bright, so to speak, there's still a lot of uncertainty. So consumers are still saving right now, so they're still holding back. Along the same lines of spending, we did just receive construction spending numbers. And so housing and construction, as we all know, was a bright spot for the economy over the latter half of 2019 and going into 2020. And what we saw was that there was indeed a decline. Construction spending, when we're looking at the U.S. Census Bureau, when they put this number out, it's a little bit lagged. So the latest numbers for construction spending shows that there was a 2.9% drop on a month-to-month basis in April. Unlike many other macroeconomic releases, when we expect April to really be the hardest hit month, construction spending might be a little bit of a laggard here. There are many construction projects that were already put in place before a lot of the social distancing measures and throughout the entire COVID-19 pandemic. But so we might still see some decreasing and some declining in construction spending as we move forward into May and June results. But this is, again, broken out into different categories. One of the hardest hit was residential construction spending, which fell 4.5%. Again, this is one of the areas that could rebound a little bit more quickly after Americans get on a little bit more solid footing.
Yeah, that makes a lot of sense, Anthony, that the residential would be the quickest one to come back. And these were April numbers, right? These aren't May numbers. These are the April numbers. Month over month, slight decline. But thank you so much, Anthony. We have John Kingston up next.
We do. I think John Kingston is ready here. And how are you doing today, John?
I'm doing fine. How are you boys?
Doing great, John.
Good. We're doing
Good.
So you're following the BMO and BMO's loan portfolio to trucking. Can you explain, BMO and their relationship and kind of their mix of business?
Well, BMO is the old Bank of Montreal. And about 2015, I believe, they bought the GE transportation business. And in that process, they became a major lender to the trucking industry. And in fact, I was at the Truckload Carriers Association meeting in early March. I think it was the last convention of any size in the trucking industry before everything started shutting down. And when you went into the exhibition hall, the first thing you saw when you walked in was the giant BMO booth. So this is a very important business for them. And we've kind of learned over the past months that looking at their earnings kind of tells you a lot about what they're seeing and how the industry is doing. So they're off on a little different cycle. So their second quarter ended on April 30th. So they just had their earnings last week. And there were some things in there that I thought were extremely interesting. The first thing I wanted to talk about was the size of their book. The book of the business for the transportation sector. Let's go over a couple of things first. First of all, about 90% of their book is in the U.S. The rest will be in Canada. And also let's note that it's not all trucking, but apparently 75% of it is trucking. So their book of business went up about 10% quarter to quarter. Now that's a huge amount. It could be that their salespeople are incredibly talented and just went out and booked a lot of business, but I don't think that's what it is. I think that's what it is a sign that it went from about $12.2 billion to $13.4 billion in one quarter. And what that means to me is that a lot of companies out there, they had revolving lines of credit. So that wouldn't have been in the book because those weren't actual loans. Those were potential loans. They followed the advice of a lot of financial advisors and pulled them down. You heard a lot about that when the pandemic started to hit. Liquidity is important. Liquidity is more important than anything right now. If you've got a revolving line of credit, pull it all down now. Yeah, you'll have to make payments. You'll be incurring interest, but the main thing is you've got to get enough cash on the books. So that was one thing that I thought was extremely interesting. Then you start looking at some of the other numbers. So the write-offs for the quarter, I'm going with my number here, they went in the quarter from the first quarter to the second quarter, up to Canadian $35 million. All these numbers are Canadian dollars, up from $25 million. That's $10 million in just write-offs in quarter to quarter. That is an enormous jump. A year ago, those write-offs were $14 million. So then we also look at the gross impaired loans. I don't want to throw too many numbers out because I know it's kind of hard to follow. But the gross impaired loans for the quarter were, let me find them here. Give me a second. I had a number. They went up to $189 million Canadian from $164 million. A year ago, it was $147 million. Let's talk about how they were at the end of a year ago. They were like $117 million. The point being that all these numbers, when you look at all of them, they showed an industry that's really under pressure. A lot more write-offs. A write-off is basically where you just walk away from it. You're never going to collect. An impaired loan is where it's hit a few metrics, a few standards in terms of how far back behind people are in repayment. So you have to account for them as impaired. So altogether, they show an industry that was really struggling.
You think one of parts of the increase in the booking business is because of PPP? Now, because it's lent out by banks, does it go as revenue or new loan origination at banks, or is this a quarter before that actually started?
Yeah, that's a great question, and I'm going to be honest and tell you I don't know the answer, but let's point out, though, that the quarter ended April 30th, and PPP, I think, started April 4th. Might have been the day that those are the first loans that went out on April 4th. So they would have only had a few weeks. But, remember something, that the bank on that one is not really holding the loan, is servicing the loan. The lender, of course, would have been the Small Business Administration. But that's a very good question, Kevin, and I will tell you that I do not know the answer.
Oh, that's okay. I don't know it either. There's a reason why I asked you. But I do remember back during the first quarter earnings season, it was 8K after 8K filings of companies drawing down any kind of a revolving credit line that they may have for liquidity. And that was in it wasn't just in transportation. That was across all industries, a lot of manufacturing, oil and gas. If you had access to that cash, grab it because it's all about liquidity.
Yeah, exactly. I do want to point out that even though some of those numbers on trucking were bad, they were nothing compared to the numbers on oil and gas. Not surprising. So that the impaired size of the book in oil and gas about doubled, a little less than doubled. So this is why it was interesting on the earnings call for the first quarter. If you could go back and look at the transcript, there was a lot of discussion about transportation, and the CEO was saying this is a business. It's an important business to us, but it's kind of troubled right now. We're certainly feeling some pressure there. They did say that they felt that a lot of companies were getting into that business without as serious a commitment as they were, and they kind of go in and then they find things aren't that great, and then they get out. In this call and in the statements made by the management, they barely talked about transportation, and a lot of it was that's understandable. First of all, they were talking about COVID-19 in general, and then specifically they talked about their oil and gas business because they had such a huge rise in the number of impaired loans in that sector.
I was just going to say that. So, looking at these numbers, John, I started looking at them yesterday. It's indicative of the health of the industry. These are smaller to mid-sized fleets that they loan to. Correct? I believe that's what you said.
Yeah, so, I believe they. I mean, the night swifts I don't think are in their book.
Right.
They might, but that's my point is that the big ones wouldn't be there.
Right. So this is, so looking at these numbers would show that size of the fleets in the United States domestically here are struggling, as you would expect, right? So are these numbers, and I think that the write-offs are those well, you have the impaired, which are you got to be watching those type of stuff, but then you have the write-offs. The write-offs were up 40% year over year. Is that right?
Yeah,
I think is what it said.
That's about. Oh no, not even year. Well, maybe about year on year. They went about 10 million, 25. No, they were about 40 million just from the prior quarter.
Just for the prior. Okay, it was just a prior quarter. Right, yeah. So that would. I mean, we're going to see. That would show that we're going to see some drop out of capacity. I would think in the fairly near future, right?
If they would write it off only if somebody's walked away. However, I would think that if it was written off in the quarter, it's gone. That capacity is probably gone. Maybe they a company can survive as a zombie. They walked away from their big loans and they can kind of keep going. But you're right. I mean, I think both numbers are very important. I mean, the impaired loans are companies that are struggling to make their payments. In some cases, they probably didn't make their payments, and so you're going to have to watch and see the write-off number next quarter. We still got about 3 months to go till we get those numbers. But it's been interesting for me. Bank of Montreal BMO first caught my eye several months ago. They put out a statement right after the pandemic started that they were going to make some provisions in their loans to extend people and make it easier during these difficult times. And as I looked into it, it really wasn't until then that I realized that BMO was such an important lender to the trucking industry. So as I've come to do their earnings the last couple of months, I think I really come to the conclusion that, this is one of those numbers that just says a lot. It's not just like one company's earnings. These are numbers that speak to the health of the industry, to the small to medium fleets. So, I know somebody, JP Hampstead and I were discussing one time that the BCO number in the Landstar earnings is considered by some people in the industry to be a really good number of capacity. Like, you get the earnings from Landstar and there's all these massive amount of numbers. Go to the BCO numbers, see, is it rising? Is it falling? That's kind of an indication of capacity. I've really become convinced that, get the BMO earnings when they come out and go to the numbers on write-offs and go to the numbers of impaired loans. And that'll tell you that's a pretty good signal of the health of the industry.
Just so I'm clear, because I'm not that smart, excuse me, but John, and like I said yesterday, when John talks, I listen, so I'm going to take an opportunity to ask him just one more time for clarity, my own sake. Write-offs would indicate that this capacity probably has already left. right?
Yeah, the bank views it as having no chance of recovering that money.
Right, and so the impaired is really what you would look to and kind of see how that's fluctuating up and down to look at the future health or what we would look like over the next quarter as far as potential for capacity leaving and the overall health of the small to medium market in this particular case, right?
Right, because if the borrower went out of business, I would seem to me you have to put that in the write-off category. They're gone. They're not going to pay you.
Yeah, perfect. Thank you.
Thank you very much for the insights on PMO, and that's a number we will keep track of very closely going forward. Thank you very much, John.
Okay.
Thanks, John.
Thanks a lot, guys. Okay.
Thank you.
Yep.
We're going to dig in a little bit later with that as well.
Yeah.
So-
And Les Willis on Facebook says Anthony Smith was spot on in that last segment.
But Anthony's usually spot on.
He is usually spot on. And John was talking about BCOs. And for those that out there, I forget exactly what the acronym stands for, but it's Landstar's vernacular for leased on owner operators in their fleet. So it gives you the number of leased in owner operators.
So it's not BCO like in maritime, the beneficial cargo owner.
No, it's business cargo. I forget exactly what the acronym is, but that's what it is. It's a number of leased on fleets, and you can go back over time, and JP and his group did that on a passport research project, maybe 3 or 4 weeks ago during earnings season, back in April. Time flies these days, but it's a historical tracking of BCOs, or the number of leased on owner operators, and basically spot rates or tender rejections.
Right.
They correlate very, very closely to all three of those.
They do, and we're gonna on Thursday, 4 o'clock, freight forecasting. John Kingston and Anthony Smith will both be on with me, and we'll be looking at these. We'll be looking at these BMO numbers that he has, and how can you really predict what's going on with capacity and
you guys should look at the BCO
rejections.
numbers too.
We should bring those on as well. That's a great suggestion, because we got to dig into all of the ISM numbers that came out as well, and dig through the different industries, et cetera, to see what's going on, to really solid indicator of not only the strength of the recovery that we have and what it looks like moving forward, but also you can look at the different markets, et cetera, by the verticals, right? Because different markets tend to have different types of productivity and production in them, obviously.
It definitely. So, and that's 4 p.m. on Thursday this week. 4 p.m. Eastern Time. You can catch John Kingston on Michael Vincent's show here.
Absolutely, because we're looking at that V. Is it going to keep going?
I know, right? At 2 p.m. today, John Paul Hampstead's joining Andrew Cox and I. Kingston mentioned him briefly. And we're going to talk about a new study by UBS, the investment bank. And they do a download, basically a download study and analysis of freight matching apps. We do a driver survey of freight matching apps as well. So we are always comparing notes and seeing who has market share in freight matching apps. So you have the third-party load boards,
right.
You have the visibility tools, and then you have like Uber and Convoy, the digital freight brokers, the pure play digital freight brokers, and then you have the legacy brokers, C.H. Robinson,
right.
Echo, J.B. Hunt, of course, 360. So it's all about market share. So we'll be discussing that here at 2 p.m. Eastern Time on FreightWaves TV, and it should be an entertaining discussion.
Excellent. I love it. Hey, let's talk about something good here real quick.
Yes, let's do that.
We're waiting to hook up with our next guest, Michael Ryan from M. Ryan Group Supply Chain, is what he's going to talk about. But here's some good news, man. Yeah. Did you hear that Molo Solution lights up charity for sick, injured truckers? If you're watching What the Truck, you saw this happen live. And Michael's here. So there's a teaser. After Michael Ryan, we'll talk about Molo Solutions and the awesome thing that happened on What the Truck. It was. I think you'll like it.
Yes, it is really good news.
Yeah, very cool. So we have Michael. We have Michael Ryan. Hey, welcome, Michael Ryan.
Good afternoon. How are you?
I'm doing well. So Michael Ryan joins us. He's the managing partner at M. Ryan Group. Is that correct?
That is correct. Thank you.
All right, excellent. So, hey, we've talked a little bit over the past couple of weeks, and your LinkedIn says that you're the inventory iceberg crusher, is what you are. I don't know if that's a self-proclaimed title or that was bestowed upon you, but can you give us a little bit of background about yourself and about the M. Ryan Group?
Yeah, absolutely, and thank you for having me on today. The idea behind the inventory iceberg is manufacturers who have either too much raw materials, work in process, or finished goods stuck in inventory, and it creates a veritable iceberg of cash. So in many cases, the CEO or the CFO will spot this bubble on the balance sheet and need help understanding in what ways the iceberg can be crushed to release the cash flow back into the business.
Gotcha. Excellent.
And I guess that analogy means that most of the cash is underneath water and
you don't
inaccessible.
see it. Yeah.
You don't see it, yes.
Yeah, and that's the idea, is that the 10% of the inventory that businesses see and feel, that's above the waterline. And then below the waterline is people, process, and technology, and how well they mesh together or don't mesh together determines how big that iceberg actually gets.
And when you look at people, process, or technology, what do you think is the biggest issue with most of the companies you see out there?
Biggest issue is process. Process needs to be definable, predictable, repeatable. You need to be able to draw a picture of it, tell us what's going to happen next, and have the same thing happen every single time. You can have marvelous people, fantastic technology, but if that process isn't there to create alignment, it's not going to create the desired result.
Gotcha. So, Michael, coming out of this crisis, and we're in the midst of hopefully a V-shaped recovery. Let us hope that it's quick and powerful. First of all, do you see that recovery in what you're seeing through your endeavors in the supply chain and through your clients? Are you seeing a strong signs for a V-shape?
I am seeing strong signs for V-shape, and what I am seeing is that different industries are going to respond with different speeds and at different times. So there may be some jaggedness to the leg of the V, but ultimately it is going to go up.
When we come out of this, through this recovery, what do you think are going to be the biggest lessons learned by companies with, dealing with their supply chain, whether it's sourcing or transportation, logistics, warehousing? What do you think one of the biggest lessons?
I think first and foremost, the biggest lesson is going to be in truly understanding both upstream with your suppliers and downstream with your customers what the availability is and what the customer's needs are, and really being plugged in to both sides of the equation, supply and demand, will help a business respond faster. The worst thing that a business can do is to get caught flat-footed, to never have talked through any type of contingency or scenario planning. So I think one of the biggest lessons learned is businesses are going to do more what-if scenarios.
Gotcha. So what are you seeing in the current state of supply chains right now, and what do you think are some of the biggest hurdles or challenges for this recovery?
In terms of the hurdles and challenges for this recovery, the biggest challenge I see is going to be around labor availability. Right now, we're in this veritable trick box where there are people who are actually earning more money by staying home. I understand that the government wants to provide and help be a bridge, help provide a safety net. It's when somebody makes a decision of, hey, I can keep my feet up and earn X, or I can actually go back to work and earn something less than X. So that is definitely a conundrum around labor that we're facing right now.
Yeah. That's a solid point.
It is a solid point. I think that type of situation is running to an end in the next few weeks. So that should, the extra $600 a week in federal unemployment benefits is running pretty short right now. I think at the end of June.
Yeah, end of June or end of July. Yeah,
June
is when it'll come back. And my understanding of that as well, Michael, is that if you're offered your position to come back and you refuse it, you don't get that extra $600 because your position is not gone from because of the COVID crisis. Is that correct?
That is correct.
Yeah, I thought that's how it was. Michael, thank you so much for being with us. Love to have you on again on another show. With us again to talk about supply chain, see what you're going. He's got a lot of wealth of knowledge, some of the new technology that's coming out and that type of stuff that we'd love to dig into a little bit when we have a little bit more time. But thank you so much. And how do people get in touch with you, or how do they learn more about the M. Ryan Group?
Easiest way is if you go on LinkedIn and type in Mike Ryan and inventory. I guarantee I will be the first result that pops up. Or you can learn more about the value that I help create for manufacturers by going to my website at mryangroup, all one word, mryangroup.com.
Excellent. Thank you so much, Michael.
Oh, thank you. I appreciate it.
Interesting insights.
Very interesting. The supply chain, as he said, what if analysis, stress testing. I keep on saying that every company out there has had their supply chain extremely stress tested over the past few months.
And a lot of them failed.
A lot of them failed, yes.
Yeah.
So I think what if scenarios, you can go into investment banking, Monte Carlo, there's going to be a lot of new techniques, new processes, new technologies that are really focused at stress testing your supply chain, getting ready for events like the coronavirus pandemic that we're going through right now.
Yeah, it's got to be flexible. It's got to be transparent. Like he said, you've got to be able to see upstream. You've got to be able to see downstream to your customers, to the consumer, and you've got to be able to cross all different modes. And within those modes, different partners within those different modes of whether it be warehousing, whether it be inventory control, whether it be data analysis, whether it be surface transportation or ocean or air.
Yeah, and the pendulum swings, right? So the last 12 years, we've gone through a recovery, very good economic times coming out of the Great Recession, and everyone was driving toward being as efficient as possible in all areas, supply chain being, a crucial one. And now, it's not the most flexible or adaptive system if it's all about efficiency. So you have to balance that. You balance efficiencies with robustness and adaptability to be able to survive events like this.
Yeah, absolutely. I couldn't agree more. There's got to be that happy medium there. You got to play that game. You got to be able to pivot and have, like I say, a kind of a living supply chain, right? It's got to be living. You don't set it and it's static. You've got to be watching it and tweaking it and taking care of it. You
definitely do. We have a couple comments before we get into the good story here.
Oh, okay, great.
And Ed Crazy on Facebook, it's annoying how many terms in freight mean something different depending on which party is saying it.
Yeah, BCO.
BCO, and
because I guarantee you that a bunch of people going, what?
He tells us what, and thank you, Ed. Here's what Landstar means. It is business capacity owners.
Gotcha.
And those are leased on owner-operators. I couldn't think of it on air a while ago. Definitely. And then also Tom Curry over at Kingsgate.
Oh, yeah.
Your buddy Tom.
Yeah.
Only 6 of the 18 manufacturing industries are reporting growth in May. Do we think the other 11 may show some signs of recovery in June?
Ooh, Tom, you're going to have to watch freight forecasting, and we'll get that question to Anthony Smith. He's dissecting those numbers right now furiously to get the answer to that, but we'll get that out there. I don't know enough about it to be able to answer that. Do you have an answer to that?
It's all a guesstimate, but I haven't seen them yet. But I think at 2 p.m. on Great Quarter Guys, we're going to roll out the Bank of America spending index
that'll be good.
on credit cards and debit cards, and in the interim, I'll go in and study those. And those are the most real-time purchasing. Both it gives you a good sense of manufacturing and the consumer, and it's real-time year-over-year comparables.
Yeah.
And we're always geeking out whenever those arrive in our inboxes every week. So stay tuned at 2 o'clock, and we'll might shed some light on it.
I don't read them. I wait for you guys to tell me what they mean.
So good news.
Let's do it. Molo Solutions lights up charity for sick, injured truckers on What the Truck. So the St. Christopher's Trucker Development and Relief Fund, CTF, drew another $62,000 closer to its $1 million fundraising goal on Monday when Molo Solutions shared its donation during a live chat on Monday's episode of FreightWaves What the Truck podcast. Knoxville, Tennessee-based CTF covers short-term expenses like mortgages, utilities, vehicle payments, and insurance premiums for truckers forced off the road by illness or injury. And Shannon Curry was on, the Director of Philanthropy and Fundraising for CTF, the Trucker Fund, was discussing the charity's fundraising goal and its growing recognition as a direct source of help when TJ Wysocki of Molo commented that the Chicago-based freight brokerage was donating $50,000. So that's pretty awesome. And actually, Molo is giving more than $62,000 because of personal donations from its 210 employees as well. So on Friday, it looked like they would not make their goal of $50,000. This is from Molo. Based on a pledge of $5 per load moved in May, Molo CEO Andrew Silver said the $48,740 on Friday rose to $50,000 by the time the monthly tally finished on Sunday. And he's going to be on What the Truck. So Andrew Silver will be on What the Truck this Friday, and we'll talk about this a little bit more.
Did they make an announcement yesterday on What the Truck?
Yeah, they did.
They did, right?
They did, yeah. They made a comment. But he's going to come in and talk about it a little bit more and talk about some other things. But, it's a great sign, and it's a great cause. And one thing that Shannon had spoke about that I wanted to highlight yesterday, that I'd like to right this second if I could, is that they go to and pay their bills. They don't hand checks to these drivers, right?
Yeah.
To the family. So they take care of their bills for them. The money's going directly to assist them.
That's good.
Which is really, really good.
That is excellent. So our lineup on FreightWaves TV, we talked about great quarter guys at 2 p.m. today. Tomorrow at noon is Put That Coffee Down, the Freight Sales podcast, and we will have Trey Griggs from HubTech on. Tomorrow we'll be talking about The Last Dance and how that applies to sales and leadership and management. Yes, I still have 2 more episodes I need to watch tonight to finish it off. It's such a great documentary.
You got the great Trey Griggs on.
Yes, we do. So we'll be talking about that at noon, and then Thursday we'll be back here for another Midday Market update at 12 p.m. Eastern Time, and then Friday we have What the Truck.
Yeah, we have
always
What the Truck
at noon. I was out Friday, so I haven't been able to listen to last Fridays, but NASA was on What the Truck. Tell me a little bit about that.
Oh yeah, that was really cool. That was really exciting. So Mark Weiss, the director of Deep Space Logistics, which is a badass title, right?
Yeah.
For NASA was on. He was talking about the launch that was going to take place on Saturday, and some of the things that they're looking at and they're doing. Cargo barges, space station or moon station based to start doing mining. They're actually going through legislation for customs clearance and negotiating with countries on mineral rights and all this kind of stuff. They're moving forward at light speed. It was really cool. And one of the things that was really exciting is that they played that episode for the Demo 2 crew right before launch.
Oh, that's cool.
Which was
pretty cool.
Yeah, it was pretty cool.
You can catch that episode of What the Truck.
Yeah, you absolutely can.
Freightcast, and that's the podcast version or the video version on tv.freightwaves.com.
Yeah, absolutely. And you forgot Freight Forecasting Thursday, 4 o'clock.
Oh, of course, with Anthony with Anthony Smith and with John Kingston.
Plugged in a number of times today. But yeah, going through this V-shaped recovery, and you see more and more support of it as I'm talking. There's more and more people thinking a V.
I know, right? It was fascinating. It's fascinating.
It really is.
Just all that goes into that you don't even really think about until you hear about it.
And leave it to Kingston to come up with loans.
I know, right? The BMO.
Yeah.
So we'll probably make that an index here at FreightWaves and start tracking that. I know we will probably write some research on it and tie it to some other data points.
Yeah, we definitely should. So, it'll be interesting to see how this keeps moving. But it's way ahead of it's the single best recovery from Memorial Day that we've seen. yet is happening right this
really
second.
good
So
numbers. I mean,
hopefully that continues, and we watch the maritime and so on, and that'll keep moving.
I haven't been a V-shaped person, but I'm starting to buy into it more and more. So, but that wraps it up for this episode of the Midday Market Update. Catch you again Thursday at 12 p.m.